Okay, so moving on to part two. In part one, we looked at the balance sheet and we went through an example of a personal balance sheet for an aspiring farmer and detailed some of the items that would be on their assets, some items that would be on their liabilities, and we covered the concepts of net worth, percent net worth, as well as working capital, which is your current assets less your current liabilities. So it's what you have basically to work with in terms of cash to run your business and get your business started. Net worth is great and long-term assets are great, but they don't necessarily allow you to pay your bills from them. If you own a house, that's great, but the only way to get money out of it is to sell it. So that long-term asset is not necessarily going to help you pay today's bill. So now we're going to move on to the income statement and the cash budget. They're two different but related statements. If we go back to our analogy of a GPS, your balance sheet would be your address. It would be where you are today. And the income statement would be like a map that traced your journey that you've made. It's basically, it's a measure over time of where your money came from and where it went, and hopefully what you have left over. So the income statement details where money comes from and where it goes. You may have also heard it referred to as an earnings statement, a profit and loss statement, or a P&L, or a profit statement, but whatever you call it, the basic formula is income minus expenses equals your net income or profit. So net income is positive when the business has more income than expense. Net income can also be negative or a loss if expenses are greater than your income. So, and many firms can be in either scenario depending on the stage of their business and what kind of year they've had. Basically, you need more positive net income to be able to afford a land purchase or a lease. So some key terms to understand are fixed costs and variable costs. They're both expenses, but they behave a little bit differently. Fixed costs are expenses that are related to being in business, to have the lights on in your shop, but they're not tied directly to production. Things like insurance, property taxes, management salary, office supplies, the phone bill, those kind of things are generally considered fixed expenses. Your interest that you're paying on loans, those expenses are going to be there, and they're going to probably be the same regardless of whether you produce 1 bushel of crops or 100 bushels of crops. They tend not to change with your production very much. Your variable expenses, on the other hand, are expenses tied directly to producing your product. So for example, if you're a greenhouse and you're producing hanging baskets, your variable expenses would be things like production labor, the cost of the pots, the cost of the media, the seeds for your flowers, those kind of things. Things that are directly tied to producing your product. And those tend to increase on a straight line basis as you increase your production. So if you grow 10 hanging baskets, you're going to have expenses related to 10 of those. If you grow 100, you're going to have almost exactly 10 times that level of expenses because they just increase with your production. Your fixed costs, on the other hand, your property tax on your greenhouse isn't going to change very much whether it's empty or full. So they behave differently. So those are kind of an important concept to think about, and we'll talk a little bit more later about why those are important. So the cash flow statement is a little bit different. The income statement covers whether you made or lost money in your business enterprise. The cash flow statement is related, but it's a little bit different because it includes some things that the income statement does not. The cash flow statement details all sources of cash that you have, as well as where all that cash goes. The key differences are things like operating activities are on both your cash flow statement and your income statement. But the cash flow statement includes as well cash flows from investment activities. If you put savings into the business, or if you make financing activities, if you borrow money, those are on your cash flow statement because they show up in your checkbook, but they're not earnings because you didn't earn that money. So if I took out a loan for $10,000, that does not go on my earnings statement because I haven't really earned that money yet. I still owe it back to the bank. But it does go on my cash flow statement because that's going to show up on my checkbook and help me pay bills. So that's kind of the difference between the income statement and the cash flow statement. They're similar and related, but they're not exactly the same thing. You can have a business, and this is particularly true with young growing companies, that can be earning money on an income statement basis on their business, but they can be in real trouble on a cash flow basis. If a business is growing and building inventory and that kind of thing, they may be earning money on an accrual basis on their earnings statement, but they may be struggling to pay their bills in their cash statement because they're undercapitalized. So, and you can run into the other situation as well. So that's why it's important to have both. One basically tells you the health of your business, one tells you whether you can pay your bills. So the three main financial statements are, just to review, the balance sheet tells you your current financial position, or your financial address, if you will, where you sit at a place in time, your assets minus your liabilities. The income statement tells you whether you're making or losing money in your enterprise. It covers the money that your business has earned, less the money that your business has spent or encumbered in expenses. And then the difference is your net profit or your net loss. And the cash flow statement keeps track of where cash comes from and where it goes. It's basically like your checkbook balance, or your cash position over time. So now we're going to move on and look at what a cash budget is. A cash budget is basically a cash flow statement that's looking forward. Cash flow statement basically details where cash came from and went to over the past time period. Usually it's a year. A cash budget is basically the same thing, but looking forward of what you think you're going to spend money on and where you think you're going to get the money to pay those bills. So it looks at what you think your cash needs will be relative to what you expect for income over the coming year. Cash flows often vary by time of year, particularly in agriculture. You may have, if you're growing a seasonal crop, you may have some big cash outlays early in the season as you plant your crop, and you may not see money coming in until fall or summer when you harvest that crop. So that's one reason why it's very important to budget your cash flow throughout the year to make sure that you have enough to make ends meet. And this is where operating lines of credit from financial institutions often come into play, where an association like Farm Credit or a bank could loan you money early in the year. You draw that down to cover your planting expenses, and then you pay it back when you're harvesting. So now we're going to create our own cash budget. I don't have a handout for this, but this would be a learning exercise. This would be a cash budget, an example for 1 month. So we start off the month with $10,000 in the checking account. And then we have different categories here. We have operations, investment, and financing. So in operations, we had $2,000 in inputs go out. So let's say this is I like greenhouses because that's where my background. Let's say we have a greenhouse and we're planting our hanging baskets. So we have labor, we have heat, we have costs of pots and media. So that went out the door. We had $1,000 in sales. So late in the month, we started to sell some crops that we had previously planted, but we still had more going out the door than coming in. And we can see here on the third column, we have a running tally of what our cash balance is. In terms of investment activity, we sold a piece of equipment or traded in a piece of equipment for $500, so that added to our cash balance. And then we bought a tractor for $5,000, so that took cash out. And then for financing, we borrowed $10,000 on a line of credit, so we had $10,000 in loan proceeds. And then we made $5,000 in principal payments, so that took some cash out. And we ended the month at $9,500, or about $500 less than what we started. Now, that doesn't necessarily mean that we lost $500 for the month, because not all of these activities are earnings statement items. For example, the loan proceeds and the principal payments are not, because we didn't earn it when we borrowed it. The tractor purchase is something that on an earnings statement you would tend to account for that over a period of time. You'd want to depreciate that asset, assuming it's going to last more than a year. So if that tractor is going to last 5 years, you depreciate it by $1,000 a year. But it's important to account for it in the cash flow statement because we paid cash for it. So we need to have that $5,000 today, even though it's not costing us that money today, if you follow me on an earnings basis. Up here, this would be earnings. This would indicate that we were $1,000 down for the month, but presumably we built some inventory, which we'll pay back in a later period. So those are all differences between the income statement and the cash flow statement. So in this case, for this month, they're actually very different because we had some investment activities, we had some borrowing and that kind of thing. So that's why it's important to, even though our enterprise may be making money, for this month, we actually had a cash shortfall. So I know it's a little bit complicated, but I just wanted to get into the differences of those statements.